All right, folks, welcome back. This is our weekend commentary for the ICT mentorship for August 7th, 2021. So we've been under non-farm payroll protocol for the week. It's been a really wonky week, as you would expect. So we're looking at the daily dollar index chart here. You see how we ran up, right back up into that volume imbalance once again. So I want to see, do we have the momentum to get through the volume imbalance? And do we even come back into touch the premium high of that? If it does, that would set up a run back into this volume imbalance and run the buy side liquidity resting above the short-term high. Do we have the momentum to take us beyond this and challenge this high here? I'm not going to say that at this point. I don't know that for certain. But if we do take out the volume imbalance premium high here, again, relative to this area over here, there's no bodies in between these two, between the opening price of this candle and the opening price of this candle. We only have one little wick there. Now we've had lots of trading in here, but we're trading right back up into it because the algorithm will remember this imbalance and these specific price points. Premium high, discount low, and the consequent encroachment in the middle. Now we traded beyond consequent encroachment here on Friday on non-farm payroll. Do we have the ability, again, to trade completely through that, or do we just revisit this as an area for a premium and then work towards getting down here? I do suspect that we're going to be going under some kind of lockdown, new mask mandate in the U.S. I think that's going to hurt the economy and it's going to push us backwards again. But we're going to obviously remain diligent and wait for that to actually happen. It's just a speculation on my part. I just think it's where we're heading, and they're pushing that Delta variant narrative to get everybody expecting the lockdowns through the normal cold and flu season. So if this occurs, that's going to put pressure on the dollar index again, and that would obviously spell a challenge of the 89.20 level. So that's a little bit long-term forecasting. It'll also hurt the stock market if it occurs, and I don't think it will be met with the same willingness by the citizens of the U.S. I think it will be a little bit more ruckus this time. But without going into all of that tinfoil hat, it's just something that's been on my mind the last few days. I've been watching all the headlines and keeping abreast of all the things around the world in different countries and such. And it doesn't bode well for calm markets. We're probably going to have a very volatile fall and winter season in the marketplace. So with that said, just keep in mind that we don't know how we're going to open on Sunday. I never know that. And I'm going to be watching how we trade on Sunday into Monday's trading. Monday's London session, I think, will be helpful in the sense that we'll be either challenging that premium high here or trading back below the discount low. If it trades back down below the discount low over here, that to me just indicates we're probably just trading up in here on Friday on non-farm payroll, pushing it up in there as a Judas, and all of these multiple attempts to go higher remains the short-term high for now. But if we trade above here, come back down in, and start to rally once more, I'll be looking for this to run through and then back into this area here and for a complete rebalance of this volume imbalance right there. Hourly chart on the dollar index, you can see we had a breaker here. So low, high, lower low that took out these relative equal lows, then rallied through, came back down into the order block, the last 3 down close candles consecutively, a triple bullish order block, trades back into that, and it's also really a breaker as well, so there's a lot of overlap there. Rallies back above the short-term high here, creates a buy-side imbalance, sell-side inefficiency, which we'll look at a lower time. It rebalances that rather handsomely, and then aggressively runs on non-farm payroll for the buy-side liquidity resting above these relative equal lows. So again, do we have the momentum to clear this? and completely close in this remaining portion of the sell side imbalance, buy side efficiency here. That would be the next objective. Dollar index 15-minute time frame. Let's see here on Thursday, the order block here. Trade to that. Short-term run here on the upside. Fair value gap, volume imbalance, bullish order block. All three trades to it there. Optimal trade entry and rallies. This is 10 o'clock in the morning right there on that down close candle. So essentially that's the New York open kill zone. And then we rally from there. But notice we're consolidating just ahead of the run here. And it takes off in the late portion of New York into Asia. Drop back down to that buy side imbalance, sell side inefficiency on the hourly chart, creating a swing low and short-term low, but is the low of the day in London. Rallies. And we have a small little optimal trade entry here. You can study this on your 5-minute chart. And then on this candle here, that's your 8:30 in the morning non-farm payroll numbers hitting the market. And it sends it up into that relative equal high on the hourly chart. We're consolidating here, so we'll look for a deeper run through on that, maybe dig into that 93 big figure. Moving on into euro-dollar daily chart. You can see we have the last up close candle in here with the biggest body. Notice I could have used this one here because it did have a higher high. I'm looking for the one that has the beefier body. This one here is your bearish order block. From the opening down to the low, we have the open, consequent encroachment, and low. We trade back up in, break back down. Consequent encroachment is traded to again on Wednesday. Starts to trade lower. Small little rebalance, immediate rebalance here. Right back to that low. And then on Friday, non-farm payroll, heavy distribution. Didn't quite get below this low, which was surprising. I thought we were going to trade through that as I was looking at it. Didn't get through that, but this is the next level of sell-side liquidity. And I mentioned last week, and I've been kind of talking about it every time I mention euro-dollar. I still like this sell-side liquidity pool. I think that needs to be cleaned up because we've seen it in cable. So pound dollar did in fact take out its relative equal lows. Euro dollar hasn't done that yet. So we might see some consolidation on cable, and I'll talk a little bit about that when we get into pound dollar. And we might see limited upside on dollar, but failure to go lower, which would allow euro dollar to trade down below this low and then attack this here. So we have our bearish order block here, and then on the hourly chart, the last up close candle again here with the highest, beefiest body. So again, when I'm referring to the big beefy candle, I'm not looking at this one here for two reasons. One, the body is smaller than the highest candle here. Even if this would have had a higher high and it had a small body like that, I'd look at this candle here. Because this is where the bulk of the volume is, and all of that's being sold into by smart money. So when they do that, they're going to want to work that same level again here, and then we end up getting it one more time passing through. I mentioned this on Wednesday's discussion. And we dropped down. We had a bearish breaker here, traded back up into that. And we have another breaker here, which we'll look at when we drop down the 15-minute time frame. And then we have a sell-side imbalance, buy-side inefficiency, fair value gap, which trades back up into consequent encroachment, and then displacement to the downside, attacking the sell-side liquidity pool here with low resistance liquidity run signatures, higher low here than that of this one. And then we have this sell-side liquidity pool next. So it cleaned that one out, but didn't quite get down below this one yet. That's what we're looking for and how we trade there on Sunday into Monday. All right, so we're looking at a 15-minute time frame. There's that breaker here we worked up into. Then we have this high, low, higher high. This closing price to the low, that's your sensitive area for the breaker. Extend that out in time, and the hourly fair value gap. We trade up into the fair value gap and the breaker here. heavy distribution on Friday in London. Small little optimal trade entry here, and then heavy distribution, attacking the sell side liquidity, and then consolidating into the close of the day. Finally, going into British pound versus US dollar, this is our daily chart. Now we've already worked out its sell side liquidity pool run here. And then we had a nice deep retracement, took out the buy stops here. Haven't really seen it trade up into here. We're consolidating, and then if we drop lower, it can be a muted retracement, not heavy distribution. I don't think we'll see the same thing we see in euro dollar because it has a reason to go down like it did in cable here. We're looking for this type of action into its daily relative equal lows. Since the cable's already done that here, and we've had a run above here, any short-term discount PD arrays like this one here and the order block, I think we're probably going to be kept at bay on the downside at this order block if it even gets that low. I don't think we're going to run back lower here. I think it's going to be held in between this high and this low here. So there's a change in the state of delivery on this candle's opening price up to the high. So we could see a retracement in that regard for optimal trade entry, get into a short-term discount, and then maybe work into an attempt to get up here if we can see the dollar fail to go higher or run under those levels I was referring to, and then give up the ghost and go lower. But basically, the star of the week going forward is euro dollar trying to run to its daily relative equal lows. That's what we're really focusing on this week. Everything else is just extra study, and just watch the fair value gap here. That might be a sensitive level to watch a run. What I'd like to see is it trade down through it, but not come down to the order block yet. Come back up into either the discount low or consequent encroachment, midpoint of that gap, hit that, and then sell off into the order block. That would be a trade I'd be considering if I was trading and operating in pound dollar. But if we take out Wednesday's high, we're looking for this level here. So again, those are the two scenarios I'm working with as a game plan, utilizing pound dollar. Otherwise, I'm looking for every premium array in euro dollar this week for an opportunity to set up a run into those relative equal lows. All right, pound dollar hourly chart. You can see we've been in a pretty good consolidation here. This is the reference points for that fair value gap on the daily chart. So we're looking for that to trade down into that there. I'd like to see it trade one more time above the short-term high to get everybody thinking it's made a low, which would be institutional order flow entry drill, and then sell off. Not that it hasn't already created that here. I'd like to see it just do it one more time to upset the weekend sentiment that everyone thinks this is probably just taking out sell stops, because now everybody knows what I've been teaching for years now. The relative equal lows, their sell stops, and they think it's going down here to go higher. I think that would be a good scenario to fade and go down to this level here and then go below it, find resistance there, and then attack the daily bullish order block on the pound dollar. Take your attention back to this level here. This is our breaker. High, low, higher high, down close candle. Extend that out in time. You can see how we work that here. The body's respecting that. Yeah, we had that wick. And we had this here, trading on Thursday, shoots up into it, and then resistance. Look at the bodies respecting that. And then one more time here. Then we sell off. And all this in here we'll look at on the lower time frame and revisit a PD array that I taught in recent months, and we'll see it again materialize in this area here. 15-minute time frame on pound dollar. Again, this is that 60-minute breaker, bearish breaker, and obviously the bearish order block here, last up close candle. Hits the bearish order block inside of a 60-minute breaker. We have a nice little optimal trade entry here. Not the right time of day, but nonetheless, you can see it's supporting the idea of that bearish breaker. Next day on non-farm payroll, lots of sloppiness in London. See that? And then we have that run up on the non-farm payroll. Doesn't really take out the highs. Does break out above the rejection block, which is the highest up close in the day and in London. So we have that there. And then it breaks down. Then it gets sloppy in here. Lots of run lower, come all the way back. The next candle, we rally up one more time and trade back down. Then we have nice clean delivery of a candle on the downside there. And we run back up here, which is redelivered rebalance. Inside of this range, okay, it works out its noise, if you will. I'm saying that with my tongue in cheek. There's no noise here, but we'll take a look at that in a moment closer. But it drops aggressively, takes out the sell side liquidity there, and then closes right on that same old low. But I'm going to zoom in here and give you a little bit of a explanation as to what's going on. Non-farm payroll numbers hits the market here. The algorithm runs up, getting everybody thinking it's going to go higher, so they chase it. Then the market enters a sell program. It breaks lower, and after it takes this big run here to the low, comes all the way back up and snaps back here to a close. The next candle opens, trades higher, and then goes lower. And then the next candle here, we roll all the way down through this low. The lows that I'm concerned with is this one right there, and then the high is this candle here, because we've exited all of this range where we went down, came back up, and started a new pass here, and then went lower than that low there. This high and this low, those are your real imbalance points. All of this, and all of this, and in this price action, all of that muddy water gets cleared up if you just go right back to the candle right before all of this mess, and you use the candle's high that took out the low that did all that back and forth price action. So by doing that, anchoring it to the opening price and the low price here, you'll get 139.07 and 4 pipettes. Notice I have this little area down here highlighted. You can go to your forex.com pound dollar chart on the 15-minute time frame, put your cursor or your mouse right on this candle right there. Okay? When you do that, what's going to occur is you're going to see with that candle, notice what the high is up here. See that high? Is that any different than the midpoint here? No. It's perfectly delivered. This is redelivered rebalance. This is one of those signatures that really highlights the fact that these markets are not random. They're not controlled by buying and selling pressure. It's not any of those other things. I'm taking you right to the core of why these markets deliver the way they do. It's not anything other than what I'm telling you it is. Okay? If it were anything other than what I'm telling you, these signatures would not exist in price. And because they exist, and it's so perfect, it begs the question, okay, if that's random price action that takes it right up to here, why would anyone that would not know what I'm teaching you here, why would they know to sell right there at that level when there's nearly nothing over here to warrant that level, to be that precise? And this is exactly what I've taught you in the beginning when I first introduced redelivered rebalance. So when you see things like this, they're hallmarks to controlled delivery and complete manipulation of the currency, which highlights the underlying premise to why you're learning this whole idea of reading price action. Because if the algorithm is referring to these price points, as I'm teaching you here, there's no reason for you to look at other things. There's no other reason to chase harmonic patterns. There's no reason to have any faith in supply and demand. There's no reason to have Elliott wave. There's no reason to have any of those things. Classic support and resistance, forget about it. This takes you to the heart of what the market's doing, and it gives you an X-ray view, even in a high volatile condition like non-farm payroll. Now, obviously, we're an hour after non-farm payroll, so 30 minutes minimum after non-farm payroll. I think if you're going to ever engage, give it at least 30 minutes. That way it works out. You know, the initial run gets the sentiment in play, and usually the public's on the wrong side of the marketplace. And you can see it in here. It delivers exactly how I teach redelivered rebalance. This is the consequent encroachment of that range. Again, the low. And then we have this big messy candle. Okay? Forget that candle even exists. Just ignore it. And then you have this candle here. Forget that candle even exists as well. Just think of it as from this candle here, we had a range from that low to that candle's opening. There it is. It's done. You've completely got rid of all of this quote-unquote noise, okay? That noise is the manipulation. We don't look at it as noise. We look at it as manipulation. It gets the market participants confused. Anyone that's seen this short-term high taken out, if they were short, they're probably stopped out and they're not going to try to get back in. Anyone that wants to be a buyer here on the volatility breakout, well, they get in just to get destroyed. So anyone watching on the sidelines, they have no idea what's going on because it's going back and forth for 30 minutes. And then finally, this little run up in here, right to a level I've taught you, precision, not one pipette off, not under, not over, right to the pip. Can't get any better. To the pipette even. That number 4 right there, that's a pipette. That's not even a full pip in price fluctuation. And it's delivered perfectly. And you don't see this taught anywhere else. And anybody else out there that's listening to these videos and you're trying to do your little Mickey Mouse mentorships, trying to parrot what I'm saying, even mentioning this to anyone else, you're going to look like you're an idiot, okay? Because you have no idea what we're going to do with it. I'm just introducing it to you here. So it's important for you to go back and look at high volatility market drivers that are coming out in the marketplace, like FOMC, rate announcements, the non-farm payroll, obviously, as we're illustrating it here, and any big news driver that creates a lot of whipsaw initially. If you go back and look at your price data and you see these whipsaw price actions and where it runs down, creates a big wick and trades back up here, and it overlaps that whole run and leaves that range, that candle, use that high, find a one candle low prior to the big, back and forth price action candle, and just erase all of that from your mind. Don't even look at it like it's even there. Forget it. And this is what the algorithm's doing. It's ignoring this candle. It's ignoring this candle because it's already did its work here. The algorithm starts to run higher, not because of buyers. Smart money traders, okay, they're not buying price to send it up to knock out these stops. That's not what's going on. You hear everybody else here that thinks they understand what I'm teaching, and they'll say, yeah, the buyers push price up. That's not what's going on. That's not what's going on. The algorithm is simply expanding and moving higher, offering price higher, 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 no matter how many people are buying. It doesn't matter how many people are buying. Every person that gets basically pushed out of the marketplace, these buy stops, as it goes deeper, 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 deeper above this, it's forcing that liquidity into the marketplace. It's not willing buyers that want to buy because they think it's going to go up. It's not always buyers chasing price because they want to be a buyer. They're squeezing on this high here. The algorithm is doing that. It's only running up to put pressure on this to induce a flood of buyers into the marketplace. So that way smart money can have willing participants. There's liquidity entering the marketplace as a result of that. So it's not buying and selling pressure. It's manipulation and repricing. That's what's going on. But nobody wants to hear it described as I'm teaching it because it gives you the clarity that you really don't have an advantage in this marketplace unless you understand what you're learning here. Once you understand that, it strips away, or at least it will over time, strips away all of the uncertainty and fear about the quote-unquote random market, which doesn't exist. There's no randomness. There are times when you want to be out of the marketplace because the volatility is uncertain. We don't know how far it's going to go up. We don't know how far it's going to go down initially when these high-impact news driver events hit the marketplace, like non-farm payroll. Because the number of passes that could happen on a non-farm payroll event, that's why I'm reluctant to trade on it. Now, I've had in the past where I've traded, and I've shared this on YouTube. I've shared it on Baby Pips. I've shared it in Telegram. I've done it on Twitter. I've traded non-farm payroll. But it's, by far and large, it's not consistent enough for me to feel any desire to be doing it every month. I just don't feel the necessity to do it. But it is important for you to go into it like I'm showing you here and really study it on an intimate level on what it's doing and mark up your charts and fill in these little empty spaces over here and over here with dialogue explaining what you're seeing in price. And you want to write it out and word it as if you knew in advance it was going to do that. And what happens is your subconscious retains that as a false memory. And you're tricking your mind to believe that you had the experience to see this coming beforehand, but you really didn't. But you're studying it and recording it in your chart as if it were just as simple as that. And because you see these things recorded in your subconscious, your brain's letting it in because you're giving yourself positive feedback. And you're basically, again, I've said this in the past, but there's no other way of saying it. You're lying to your subconscious that you were able to see this before it happened. And for someone that is hypercritical, very judgmental, that sounds like foolishness. But this is how you master the psychology side of reading price. You train yourself to believe that you can see these things in your back study and back testing and filling up your journals with examples of pseudo experience. And by doing that, you end up teaching by default your subconscious to see these things because it remembers, oh yeah, I remember the last time I did that and I had a positive response because I recorded it and I have a memory of it. When all you're doing is filling your brain with false memories about something that you didn't really necessarily see beforehand, but you have so many examples of it. When you start seeing the similar characteristics in price action when it's happening live, what's your brain going to refer to? The only thing it has as experience. These good, feel-good moments that you've recorded in your journal. You may not remember every small detail or every finite little nuance that's in there, but your subconscious does. And it releases these chemicals in your brain that will override the normal fear and uncertainty that a retail trader has because they're just impulsively going in there and chasing after price. So this is why mentorship is not a one and done. It's not a, let me train with you for a couple of days and we'll call it a workshop and now you're ready to trade with real money. That's not true. You're not taught the right things with these short little span teaching cycles. Like you have to be under the tutelage for a long time to get the benefits of someone, well, in my opinion, to get the benefits from someone like myself with almost 3 decades of experience. So you don't get this from reading a book one time or watching a couple videos on YouTube. You get it from being pressed into these examples and forced to see them as you should see them and studying them in a very specific manner. And by doing that, you'll master psychology and you'll also conquer fear and greed. You won't be tugged by either one over time because the first person you have to beat and master is yourself. And you don't realize how subconsciously you're tricking yourself into thinking that you're never going to be able to do this. You might get one hit wonders here, a little bit over there, or get into something and you think it's going to go somewhere, but then you get scared out of it because you don't want to feel like you've done something wrong and be demoralized over it, even if it's a demo trade or a paper trade. And then when it squeezes you out of it because you just can't hold on to the whole idea of it, then it goes to where you thought it was going to go. And then that hurts, it's pain. So what's actually happening when you're doing those things is you're filling your brain and your subconscious with negative memories and experiences. And then what you end up having is real, tangible memories that you've created by doing these things improperly, practicing them improperly, not submitting to the ideas and saying, okay, it feels uncomfortable. This is a period in time where I'm holding this trade and I feel uncertain about it. You need to log that. But when you're logging it, say, it's normal for me at my experience level to feel a little bit of uncertainty. But I'm sticking to this plan and process, and the rules say I should do this and this and this. That's it. There's nothing emotional outside of that. You acknowledge that you felt that way, so that when you go back and look at your examples and your logs, if you will, in your study journal, you'll remember, oh yeah, I remember having that feeling that you won't necessarily have in the future because you gravitate away from that by doing the right things and recording the positive side of everything and not really leaning so hard on the things that you didn't necessarily see or that you did wrong. So it's important over at least 12 months. You see the whole money cycle over the course of a full year. You see all the volatility injections that come by way of the economic calendar, and you study all of that, and you retain everything as an experience, but you filter it through a positive filter. Not, oh, I'm never going to do this right. I'm going to fail. I need to make money right now because Michael's talking about I have to buy canned goods and everything's going to be running out of the store. And I'm not trying to make light of that, but I can see how some of you are probably, your heads are probably spinning most of the time. There's so many things to be worrying about right now. And that's the reason why I tell you to get prepared, because if you are, you won't have all these things to worry about, in addition to the normal adversities that come by way of trying to learn this, because it's a very difficult skill set, because it's 90% psychology. 90% of it is psychological. Trading itself is very simple, but doing it and having no fear or greed or natural impulses to put out like little landmines in front of you where you self-destruct and you derail yourself, those things are conquered by entering positivity in your journals and studying them with a perspective that you saw it coming beforehand. And over time, I know some of you that are, again, hypercritical, you'll think to yourself, oh, you're just lying to yourself and you're kicking the can down the road and that's never going to work. Okay, you're entitled to your opinion. But until you actually do it and see how effective it is, your opinion is just that. It's opinion. I did this the same way, and most of my successful students that are actually able to make money here, they've done this. Okay, that's the secret to it. You got to back test, you got to study, journal, and filter out all the negative stuff. And that's why you don't go on social media. You don't go into that toxic wasteland, Instagram. You don't believe all these people that are lying and stuff, because they have no idea what they're talking about. They're pretending. Okay, and that might sound like a oxymoron, because I'm telling you to pretend that you are successful when you're doing your back testing and lie to yourself in your journals. But that's how you master the psychology. Like, you fill in these voids in your memory with things that are positive, that feel good, and the very thing that you should be gleaning from these moments in price action. And because they're doing these things over and over and over again, they repeat. Why? Because the algorithm is not evolving. The algorithm is not evolving. It's been doing the same thing. In fact, this is the same thing that floor traders would do. They just go right back to the time interval prior to this big whipsaw. What's that low? Right there. And where do we open up on a new candle after we pass through that low? That's what we're doing. Okay? So the algorithm, because it's taken the logic that has always been in making markets and how price is delivered, all these little intricate little things that make price behave the way it does, not because of buying and sellers. Because if it was just buying and selling pressure, if it was really supply and demand factors, it would not be this precise all the time. It just repeats over and over and over again. How many times have you seen the candle for a bearish order block? It trades right to the opening price and not one pip beyond it and turn right on a dime. You're telling me that the idea is the markets are random and buying and selling pressure is what controls price. But yet, one trader out of everybody on the planet knows to be the seller at the highest point when it touches the opening price of a bearish order block. And that repeats so many times. And it's going to be what? Just that one trader in the world that's doing that? When you strip it down like that, it really becomes a facade to believe this narrative. All you have to do is take some time and study price action, and that myth falls apart. It cannot stand under the scrutiny of really detailed study. That whole idea of supply and demand, random markets, and nobody knows what's going to happen, that right there is a lie. That's a lie. Now, you're not, just like I can't know every single movement that's ever going to happen all the time. I miss moves. Sometimes I second guess because of all the uncertainty in the world right now. Like I mentioned, very honestly, 2020, I dialed back so much. I took less than 2 dozen trades the entire year. So I'm respecting the level of risk, and we're entering another level of risk, lots more risk. And I think what they saw in what they were able to accomplish over the year of 2020, they don't want to relinquish any control that they've been able to get. Okay. So, and it's not, what I'm not referring to is just American politics and such. I'm referring to global politics. And all of these things are working towards that. So that measure of risk is, we're in uncharted territory, like literally. And we are in an area in the marketplace in a time where multiple black swans can occur. And I'm talking about flash crashes like you've never seen, or explosive rallies that just completely blow out everybody that would be in that market going short. Like, that's where we're at. And I think it'll probably be like that until we get into next spring. Now, does that mean no trading? No, that's not what I'm saying. I'm just saying don't go in heavy-handed in the coming months before understanding how much risk is really in the marketplace right now. So, yes, be nimble, but demand real clarity in what you're expecting in price action. Know what you're looking for, know why you're looking for it, and if it doesn't give it to you in this climate, don't risk it. Study it and just get the experience without the pain if you're wrong. Some of you are trading with funded accounts now. Please heed my warning. Trust me when I tell you, this climate can literally end you. Easily. One event, one small little miscalculation on your part, thinking, well, I'm going to do a heavy leverage trade here, and I'm going to wait to see where I'm going to put my stop at later on. Don't do that. Don't do that. Don't take those risks in this environment. Okay? Have your stop. If you get stopped out, be thankful that it stopped you out where you got out of. Because we could be entering a market phase where there is no liquidity. Like, all of the interbank traders are taking a step back and they're waiting. And then you'll have market moves that just completely decimate both sides of the marketplace and scare everybody. And then it gets hard for a little while. And the markets can be untradeable for a number of weeks or so. And that will scare so many people, because why would they want to do that? And that's, you're probably thinking right now, why would they want to do that? If they don't want people to get in the marketplace, how are they going to be able to get in and have liquidity? Because they don't want the number of people that's in there right now. Everybody has done what over the last year? Look for alternative means of income. And everybody wants to be a sit-at-home stock market day trader. Everybody wants to sit home and play the crypto markets. Everybody wants to be a Forex guru. Everybody wants a Lamborghini. Everybody wants to have these Instagram lifestyles and pretend that what's going on around them isn't really there. So what are they doing? They're in the marketplaces. Stocks, commodities, futures, indices, Forex, crypto. Everybody's pouring into these markets. When a time of historical stock prices, we've never been here before, unwarranted. The level of where we see stocks right now is absurd. Like, it's absolutely ridiculous. They shouldn't be where they're at. And there's going to be a reckoning. And I think if we lock down one more time, that's it. Like, we're basically putting the nail in the coffin for U.S. equities. And it would be violent, because they saw how fast it dropped last year. And while it was relatively controlled, I don't think they'll be that forgiving this time. And in Forex, the way they smash those traders is they do like they did with the Euro and Swissy. Put a flash crash in that no one can survive. And in this environment, there might be a lot of job openings, but nobody wants to work because they want to stay home and get that free money. But if they have an interest in trading these markets, guess what's going to happen? They're going to be scared out of it. Why? Because they need fear to control people. If they think that they can stay home and make money trading, are they going to be fearful? No. Just like I'm teaching you not to be fearful. I'm not teaching you to be afraid of the boogeyman in the financial markets. I'm not doing that here. I'm giving you a sober perspective, helping you elevate the level of respect to the risk that's in the marketplace right now, and to have the proper mindset to know why should you and I expect some level of ridiculous volatility that is essentially untradeable, which is a black swan event. It's looming right now. Now, you could be thinking about these things and say, oh, I'm scared to death now. I'm like, oh, I don't want to take any trades. Well, that's not my goal here. I want you to be able to engage, but don't think that you're trying to get rich in these markets right now. That's not the case. Next spring, with the grain markets, yes, that's where I'm focusing, because they're decimating all the grains right now. And they will not have the water. They will not be able to do those things. You have midterm elections next year. There's so much being moved around on the chessboard right now. The whole theater is coming out. Every player in the theater is coming on the scene in the stage right now. And all these things are coming together perfectly. And it's maximum carnage. That's the goal. Maximum carnage. How do you do that in the marketplace? You crash stocks. You crush currencies. You do wild whipsaw moves that literally just level anybody, because they know everyone's over leveraging. And they know that people that have sat home and figured out how to trade Forex, they're in there over leveraging. It only takes one specific type of move, and those accounts are gone. And they're not going to be in a hurry. They're not going to have the resources to go in and say, let me go into my savings account and put that back in the account so I can continue doing what I'm doing. It's going to completely scare them to death. So that way, they'll fall back in line with all the things that your television tells them and scares them to death. This is going to kill them. You can't do this. You can't see your family members. Believe this is going to kill you. This is the worst case of this thing that's going around the world right now. And all of that stuff is designed to control you. And I'm not here to try to scare anybody. I'm teaching you how to be an independent thinker, respect the measure of risk, and do it properly. All these things I'm teaching you, if you ever have any anxiety about what's going on, do the things I'm telling you to do on back study and back testing and logging. Spend your time there, because what you're doing is you're not watching the television. You're not listening to news that's literally trying to tell you to be fearful all the time. Have no hope. Okay. There's going to be moves in the future, folks, but not every single one of these moves are viable means of profit that brings with it a measure of risk that is reasonable. In layman's terms, you got to pick your trades more carefully now. You have to use impeccable risk management. Do not over leverage. In fact, if you do anything over 1% risk, you are asking for damage. You're begging for it. So keep your leverage at 1% or less. Even in your demo trades, even if you're paper trading, 1%. And if you've made it to FTMO type funded accounts, or if you got your own account and you're finally trading as a charter member, please listen. Do not push it, because this type of environment could literally wipe you out. Like Damage Incorporated. You have no idea how painful it can be. Your stop loss will not work in a flash crash. It won't be there because the market will reprice way beyond it. This is why I'm talking to you the way I'm talking to you. This is why I'm holding you by the lapels, staring you in the virtual eyes, and tell you, do not play games in this environment. We are in really perilous times in the marketplace, and anything goes. Anything goes. If you listen to me, you'll be in a better position to weather any of these storms. You won't be scared to death. You won't be shocked. You won't be surprised because we're anticipating it. We're not fearfully treading every single day. Anxiety. No. We just know that, hey, look, I'm going to take the signals. I'm going to follow the logic that's being taught here. But I'm going to have such a controlled amount of leverage with the risk that even if these things do occur, it's not going to end me in one trade. It's not going to be required of me to trade every single day. It's not required of me to know the daily high and low and anticipate that and trade it with that very model in mind. Take your pound of flesh or a couple ounces of flesh, okay, and be content with that. Hopefully we move out of this climate, but it probably won't be until we get on the other side of the midterms next year in the U.S. That's my interpretation. That's how I'm looking at it from an American trader, because those things will influence our stock market, it'll influence our economy, and it'll influence our leadership. So I'm expecting some tomfoolery. I'm just going to be honest with you. I'm expecting them to lock things down to guarantee that there's no in-person voting. And some of you in here that voiced your opinion the last time, even though I asked you not to, because it's just going to irritate me and I won't want to listen to you. Okay, I won't read your email. I know some of you are hardline Democrats, and I pray for you all the time. I think that your party is going to pull out all the stops because they don't want to lose their power. They don't want to lose their seat, and it has nothing to do with Trump, period. I only brought him up just to show you and tell you that it has nothing to do with him. In their eyes, they've moved him aside. He's already fulfilled his role. They don't want to lose what they have, and they want to gain more power, more control, and they don't want to be unseated, period. So there's a lot of things that can happen between now and the midterms of next year. And as I stated, nothing is off the table. Everything is possible. Everything is a potential black swan. And any one of these events that kick off has the potential to be the perfect red herring, to have everybody's attention over here. Over here, look at all this stuff right here. And then I'll explain to you later on, 6 months, 12 months later on, what really happened. But you're going to be lied to as to why it happened at the moment. And that lie is going to scare everybody. And traders won't be able to trade. Investors will be wanting to get out of the marketplace. And it's just going to create this bloody water. And then that's when the sharks come in. Smart money will come in and work in that environment. But right now, we do things as we normally would, but keeping the risk very, very low, 1% or less. I mean this, folks. If you do anything above that, you're doing it wrong, and you will regret it. That's going to be it. I celebrate my 49th birthday tomorrow, and I'm going to do my best to enjoy it. And I thank you all that have sent your birthday wishes. Please don't feel like you need to. Receive enough of them. Okay. If you're a charter member, you can obviously, share your experience so far in the mentorship and what your views on how you gained, and post that in the forum in the charter area. And that would be a wonderful birthday present to me. And so I'll talk to you on Monday. Be safe.